Welcome everyone to our Insurance Code adventure. In today's journey, we'll navigate Title 10 and 11. Power up with knowledge and collect insights, all to reach our ultimate goal of understanding and ready to conquer the insurance world like a true champion. Get ready to level up your learning as we start this adventure. Let's jump in and start our adventure into Title 10, Variable Contracts. Section 238 mainly talks about variable contracts. Insurance companies in the Philippines cannot sell variable contracts without the insurance commissioner's authorization. This ensures financial stability and public protection. Variable contracts differ from traditional fixed policies and aren't classified as regular securities, as they are defined as policies where benefits fluctuate based on the performance of a segregated investment portfolio and may also provide benefits or values incidental thereto, payable in fixed or variable amounts or both. As the company asks for authorization, the commissioner rigorously reviews a company's financial health, leadership, and for foreign companies, their home country's laws and regulations, and a mandatory local deposit of 2 million pesos. The process for granting or denying authorization involves notice and hearing, ensuring due process for the insurance company. If an application is rejected, the commissioner must provide clear and specific reasons, promoting accountability and allowing the company to understand the basis of the decision. These rules prioritize consumer protection and transparency in offering these potentially more complex insurance products.
Section 239 gives insurance companies the discretion to offer variable contracts that combine both fixed and variable benefits. This means that a policy may include guaranteed amounts such as a fixed death benefit along with variable components that depend on the performance of certain investments. Additionally, insurers may provide the option for policyholders to receive benefits in lump sum payment, giving greater flexibility in how insurance products are structured and how benefits are paid. Section 240 emphasizes regulatory oversight. It requires that every variable contract form, along with any associated documents such as applications, riders, and endorsements, must be approved in advance by the insurance commissioner before being issued or delivered in the Philippines. This applies to both individual and group contracts. The purpose of this requirement is to ensure that all variable products meet established standards and offer sufficient protection to policyholders. Section 241 provides clear guidelines regarding how the benefit of variable contracts may be illustrated. It strictly prohibits insurers from using past investment performance to project or imply future returns. This helps avoid misleading policyholders and ensures that all benefit illustrations conform to the rules and regulations set by the insurance commissioner, promoting transparency and fair representation. Section 242 allows variable contract to be issued on an industrial life basis, which typically involves small, frequently paid premiums and is often marketed to low-income individuals. However, such contracts must still fully comply with the relevant provisions of the insurance code and the regulations issued by the commissioner. This ensures that even in the industrial life segment, consumer protection and regulatory standards remain in place.
Section 243 of the Insurance Code. Under this provision, insurers must pay claims within 30 days after receiving proof of loss and completing the ascertainment process through agreement or arbitration. If ascertainment isn't made within 60 days, the payment must be settled within 90 days. Failure to pay within this time frame entitles the assured to collect interest on the proceeds at twice the ceiling rate set by the Monetary Board. However, If the refusal is due to fraudulent claims, this penalty does not apply.
Moving on to Section 244. This section allows insurance companies that offer variable life insurance products to invest the funds from those policies in a wider range of investments. These can include approved securities under Sections 204, 206, 207, and 208, such as government bonds and other safe investments. But it goes further. The law also allows investments in common stocks or equities listed on the Philippine Stock Exchange or publicly traded over the counter as long as the market is regulated and transparent. However, there's a limit. An insurance company can't invest more than 10% of a variable account's assets in a single corporation stock to avoid too much risk. Finally, these investments are kept separate from the company's other assets and are not counted toward regular investment limits. And when buying these stocks, the company must clearly indicate which specific variable account the investment is for. In short, this section gives insurance companies more flexibility to grow clients' funds through diversified investments while maintaining safeguards against risk.
Now, let's continue with Section 245, which says, assets allocated to any separate variable account shall be valued at their market value on the date of any valuation, or if there is no readily available market value, then in accordance with the terms of the variable contract applicable to such assets, or if there are no such contract terms, then in such manner as may be prescribed by the rules and regulations of the Commissioner. So this section is about how to determine the value of the assets tied to a variable contract. The main rule is use the current market value of the asset on the date it's being evaluated. If there is no market value available, check if the contract provides a method for valuing the asset. If it does not, then the insurance commissioner will prescribe how the asset should be valued. So the law ensures that assets supporting variable contracts are valued fairly, starting with market price, then falling back on contract terms or regulatory guidance when needed. Now, Section 246, which says the reserve liability for variable contracts shall be established in accordance with actuarial procedures that recognize the variable nature of the benefits provided and shall be approved by the Commissioner. So this section deals with reserve liabilities, which are the funds an insurance company must hold to guarantee it can pay out future benefits. Because variable contracts offer fluctuating benefits, the reserve must be calculated using actuarial procedures that reflect that variability. These procedures must be approved by the insurance commissioner, ensuring they're appropriate and safeguard policyholders.
Now, let's start the next level and move forward into Title 11, Claim Settlement.
Section 247 is a law that protects people who file insurance claims. It says that insurance companies are not allowed to unfairly delay, deny, or avoid paying claims without a valid reason. For example, they can't lie about what your policy covers, ignore your messages, delay investigating your claim, or offer you a much lower amount than what's fair, just to pressure you into giving up or going to court. If an insurance company does any of these things repeatedly, it's considered an unfair business practice. People can report this to the insurance commission and the company can be investigated. If found guilty, they could face penalties, including suspension or even losing their license to operate. So basically, this section makes sure insurance companies treat their customers fairly and responsibly when handling claims.
Section 248 in the Insurance Code is about what the insurance company does when a life insurance policy ends. The insurance company must pay the money right away unless it's said to be paid in parts, installments, or annuity, in which case they pay on schedule. If the policy ends because the insured person died, the insurance company must pay the full amount within 60 days after the beneficiary submits a claim and proof of death. If the company delays payment without a valid reason, like fraud, they must pay interest, double the rate set by the monetary board for the time they are late. Also, if the person paid premiums in advance before they were due, the company must return the unused portion of those early payments to the beneficiary as part of the total payout.
In Section 249, if an insurer is liable for loss or damage under any policy, except life insurance, the insurer must pay within 30 days after first receiving proof of loss and second after the amount is determined either by agreement with the insured or by arbitration. However, if the amount isn't determined within 60 days from receiving the proof, the insurer still has to pay within 90 days from receiving the proof. And if the insurer refuses or fails to pay within the time limits and the claim is not fraudulent, the insured can still collect interest on the amount due at twice the legal interest rate set by the monetary board for the period of the delay.
Section 250 is a consumer protection provision that penalizes insurance companies that unreasonably deny or delay paying valid claims under an insurance policy. When does Section 250 apply? This section applies only when there is litigation, that is, when the insured or beneficiary files a legal case in court or brings a formal complaint before the insurance commissioner to enforce an insurance policy or contract. The key issue that must be decided is, did the insurance company unreasonably deny or withhold the payment of the claim? What must the court or commissioner do? It becomes their legal duty to make a specific finding. Was the denial or delay of payment unreasonable? This means they cannot just ignore this issue. They must actively determine if the insurer acted in bad faith or without valid justification. If the insurer is found guilty of unreasonable denial or delay, then the insurer is legally required to pay more than just the claim. They must also pay the damages, which include attorney's fees, other expenses incurred, and interest penalties. Section 251 is a part of the Insurance Code that criminalizes insurance fraud, specifically any act of filing or assisting in filing a fake or fraudulent insurance claim. It serves to protect insurance companies and the public from deceitful acts that undermine the integrity of the insurance system. What acts are considered unlawful under Section 251? There are two specific acts that are prohibited. A. Presenting a fraudulent claim. It is unlawful to present or cause to be presented any fraudulent claim for the payment of a loss under a contract of insurance. This means it is a crime to personally file a fake claim, help someone else file a fake claim, submit documents or statements that you know are false in order to collect money from an insurance policy. B. Preparing fraudulent documents to support a false claim. It is unlawful to fraudulently prepare, make, or subscribe any writing with intent to present or use the same. This refers to creating or signing any written document that is false, knowing it will be used to support a false insurance claim. Even if you're not the one filing the claim, just making or helping prepare fake documents for someone else's fraudulent claim is still punishable under this law. Penalty for violation. Anyone found guilty of violating Section 251 may face a fine of up to twice the amount claimed or imprisonment for up to 2 years, or both, depending on the discretion of the court. Note the penalty is heavier when the amount fraudulently claimed is large because the fine can scale based on the amount claimed. Purpose of Section 251. This section is designed to deter dishonest individuals from abusing insurance systems, protect the insurance industry from financial losses, and maintain trust and fairness in processing claims. Insurance fraud can increase premiums for everyone. This law helps ensure that only legitimate claims are honored.
And just like that, we've completed Title 10 and 11 of our Insurance Code quest. Through this adventure, we've collected essential power-ups of knowledge. But remember, this isn't the final level. The world of insurance law keeps evolving, and it's up to us to keep playing, keep learning, and keep winning at every stage. So before we move on to the next legal adventure, thanks for joining us. Let's keep striving for higher learning.